Hi, welcome to UOB Hian CIO Series number 30. Today, we'll be sharing our official outlook for 2026. My name is Wang, CIO of Private Wealth Management at UOB Hian. I'll be your speaker today. This is also the last CIO Series for this year. And before we begin, I would like to thank our marketing team in Hong Kong, our marketing team in Singapore, our IT team, as well as our external partners for continuous support and making this webinar possible. And today's webinar offers Chinese subtitle or other language subtitle translations in Microsoft Teams. If you're not sure how to do that, please use AI or Google to find out the exact procedure. The language will be in Chinese, but the language will be in English, but there will be translations available of the subtitles. And just a reminder, for our last CIO series, number 29, I already reviewed our 2025 predictions. And here's a replay link on our Wealth Vision channel. Please subscribe to our YouTube channel here. And there are some clips. If you don't want to run through the whole replay, there's some short clips that you can watch to get the key points. And like I said, our last webinar, I already offered a longer term outlook, not just 2026, regardless of 2026, 2027, or even longer. We are looking at 3 disruptive forces for the very long term. And these will be permanent topics for us, and they will continue to change and influence the market as we head into 2026, being the US-China relations, de-dollarization, and AI. And as I said before, when you look at these 3 forces, whether it's in 2026 or beyond, we are looking at possibly continuing challenging US-China relations, and we expect de-dollarization to continue next year and beyond. And for AI, it's very important to know that we expect a temporary slowdown in AI capex. So there might be some cloud gathering over the AI industry. We've talked in details already before. And this leads to my number 1 prediction for 2026, which is exactly what I just said earlier. The AI capex is expected to slow, and that will have a major impact on the US economy and the entire AI supply chain. We're not expecting a negative growth, but the growth was slow from something like 50% to 25 to 30%. Regardless, it's not going to be another 50 or 55% growth again in 2026. Nothing goes up forever. And this doesn't mean that we give up on AI or big tech. My recommendation is really to stay invested, but be aware of this slowing growth in AI capex, and watch and control the risk accordingly. And also, it will be good time to add some defensives, which I will talk about in a second. Number 2 prediction, my view that the Hong Kong China markets will continue to be limited by a sluggish economic recovery. As you recall, my number 1 prediction for 2025 was better than expected Chinese economic growth, which it did happen in the first half of this year. But looking forward to 2026, I don't think we are going to be that optimistic. Reason being that, especially in the second half, we are seeing continuous slowdown or continuing challenges in the real estate market and a slowdown in exports. Both factors will continue to weigh on the Chinese economy, and we're ready to change our view anytime from cautiously optimistic on China, too cautious if the economy remains sluggish into 2026. So stay tuned. We will watch very closely the macro data out of China in the new year and ready to adjust. Number three, I said earlier, the U.S.-China relations will not get better. Will not get better in 2026 and will not improve over the long term either. And main reason being that U.S. is heading to the midterm election, and despite the truce between Xi Jinping and President Trump on trade matters, there are many other competitions and conflicts between U.S. and China. And what we are seeing right now when we talk about U.S.-China issues is increasingly about AI. So think about the timeline. In the beginning, it was about trade. Since the 2018, it turns into something about technology. And within technology, the U.S.-China rivalry is centers on AI. And that will be a very big topic in 2026 and also present opportunities as well as risks. So my advice is really to not to take any sides here, but we need to be positioned in both U.S. and China AI stocks, because both U.S. and China each have their own advantages in AI. And this is something we discovered in 2025, that China may not be that behind in the U.S. in terms of AI, and especially in edge AI, AI devices, and consumer AI apps, China has many advantages. So another reason we need to look at both U.S. and China AI stocks. De-dollarization will continue. We talk a lot about de-dollarization since the beginning of this year. We've been right on about this, but there are also a lot of misinterpretations, which I will explain in a second. We view the safe haven currencies like Singapore dollar and gold as long-term beneficiaries. But don't forget, RMB is also a potential beneficiary of this trend. And we're seeing RMB appreciating significantly in the last few months since we talk about de-dollarization. And RMB, as you know, has over the past few years been a undervalued currency. So now we're just getting back to normal levels. So I'm positive RMB for the long term, positive on gold. But like I said, 2026 not going to be easy. The title of today's presentation already suggested the year of the white horse, suggests that is not going to be a peaceful year. So prepare for volatility. Even in assets like gold, there may be some volatility. So brace for that. And lastly, here's something that we think differently from most of the views out there, which is people are optimistic about the December rate cut by the Fed and optimistic about a new Fed chair to replace Powell. This new candidate coming from the White House and the Trump-friendly, very dovish, and seems all good from here. But I don't think it's necessarily good news for the market. We just don't know. I don't think it's bad news necessarily, but we just don't know, because Wall Street has consistently miscalculated the Fed in the past. I'm not sure you guys remember higher for longer, which was wrong. And the 6 rate cuts for this year was also a bad prediction. So most of the street predictions for the Fed has been wrong. So now we'll not be surprised if we are wrong again. So be cautious there. And my advice for bond investing to stick to more short to medium term bonds, top rated bonds, to stay in the safe zone, to avoid as much as possible this Fed uncertainty. There's a lot of words in the previous table, so it's not always easy to present, but here's a visual aid to help you understand my 5 predictions. I talk about the great AI cool down, the CapEx slowdown. China will have the growth issues, the GDP, the economic backdrop remains weak and sluggish. That will cap the stock market upside. I call it the China's growing pains in 2026. I mentioned the U.S.-China AI arms race. The U.S.-China competition essentially becomes an AI competition now. And then de-dollarization, I'll call that breaking the dollar's grip. That was also the title of our CIO series way back on this. And the Fed wildcard to show the Fed uncertainty exists and continues into 2026. Hopefully it'll be helpful to you and your clients to understand these 5 predictions. So if you want to summarize this in one word for 2026, it's defense. I'm not sure you remember in September 2024, when everyone's so bearish on China, we had this series, CIO series on how to pick defensive stock. And the word we use called true defensive framework. And here's a replay. It's an ROIC-based framework to help you screen and select true defensive stock. And that will be very essential again in 2026 as part of our barbell strategy. Let me talk about the barbell again. You've probably seen this before. The barbell strategy, you invest in very risky, high growth, high volatility stocks like AI and M7. On the other hand, you also need to be positioned in defensives. And I think back to 2026 outlook, I think this is the year to be defensive and the year to shift more towards the defensive end of our barbell strategy. Again, not to sell everything in AI or M7, but you need to have both and you need to weigh more towards defensives. What are the defensives in our portfolio? So here are some of the core recommendations. Berkshire Hathaway, Walmart did very well this year and last year. P&G, which we just added to our core recommendation last week. In China, we have China Mobile, we have PetroChina, and there's actually a basket of stocks that behave like China Mobile. They pay dividends like China Mobile. Bosera has something called Central SOE High Dividend ETF 3437. It's our trading buy. You can see the top 10 holdings here. If you don't want to own single stocks, this would be a good way to have a basket of what I call defensive stocks in Hong Kong. Well capitalized, strong balance sheet, strong cash flow, dividend payouts. That will be continuous theme in 2026. A good place to be in 2026 amid all the uncertainty and market volatilities. And how do they perform? How do these stocks perform? Here, I look at how they did the U.S. defensive as well as China defensive, how they performed during the downturn earlier this year. Remember the tariff-driven crash. The market had global markets had major corrections at that time, and all these defensive performed. Most of the defensive performed as expected, meaning they have more downside protection. In some cases, they were actually up when the market was down. On average, they were down a lot less than the market, a lot less painful than you just own the index or own AI stocks or tech stocks. And most people associate this with boring. It is true. Defensive stocks are boring, but I want you to think about Michael Jordan because this is a good analogy. There's a good analogy here between play defensive and play like Michael Jordan. And very few people know this. Actually, Michael Jordan is a very good defensive player. He's arguably one of the best defensive players in the NBA. So it's not necessarily boring. It's actually essential to be a good player in this market is know how to play defense. And just like Michael Jordan, we all know Michael Jordan averaged 33 points a game, 30 points a game, over 30 points a game. But he doesn't score every game with 30 points. There are games that he scored only 10 points. And actually one of the worst games he played, he scored only 2 points, which is right? Unthinkable for Michael Jordan, but it happens. So that would be like 2026 again, where maybe not all of your stocks will do well. Maybe the market may not do well. And what do you do then? We have to learn how to play defense and be positioned defensively. So I cannot stress this enough, that as part of the portfolio approach to prepare for a uncertain 2026. And in the spirit of that, we just added P&G. We need more defensive names. We need more defensive weights in our portfolio. P&G is a good candidate. Why? Because it's a large cap stock with one of the lowest volatility in terms of return on invested capital. It's a bit technical here. If you wanted more details, please look into our report or the webinar on the true defensive I showed you earlier. It's a global leader in consumer goods. They have averaged 25 to 60% market share. Now, 25% market share may not sound that much, but remember, some of these markets are very fragmented, like toothpaste or cleaning supplies. So if you have a 25 or 20 something percent market share, you're already the number one, which in this case, P&G is the number one, and the number two is a distant 10% or 15%, right? So their dominance is apparent in many of these products here. And lastly, they have successfully built a brand, a mind share among consumers, be able to charge a premium for their products like laundry detergents. And Warren Buffett also talked about the consumer mind, like Coca-Cola is very successful of building a brand image among consumers. The happiness associated with Coca-Cola, the user experience, the consumer experience with Coca-Cola is almost perfect, right? So P&G has, to a certain extent, followed Coca-Cola's success in terms of building this mind share, of conquering the consumer mind in terms of their product quality, the premium pricing, et cetera. So very interesting company. It is boring. There's very low growth, but it's defensive. Like I said, essential in 2026. And you don't have to do everything alone. You have our CIO office. You have me personally. You have, over the last few years, built robust private wealth management research to support you. Plus, I personally selected a few top managers, fund managers at our disposal. Now, how do I pick these managers and how you should pick managers? Here's a few things that I will consider. Number one, the performance consistency is very important. So when I pick these managers, I don't look at 1 year or 2 year, I look at longer term track records. In the case of a startup manager like Aqua Lake, I look at the previous track records when the founders were working at a different shop. That's very important to evaluate them over longer time periods, see whether they can really deliver alpha consistently. And transparency is very important. I cannot stress enough. There are funds that come to us that cannot offer us the top 10 holdings, cannot explain clearly what stocks they own and how do they deal with the risk, how do they earn the money. It's not good to me. So the transparency is also up there. And they need to be willing to share. And we need to also have access to the investment team, not just the sales and marketing people. We have a lot of fund sales and marketing people come to talk to us. Maybe it's interesting to you, but to me, it's not that helpful. I want to be able to talk to their CIO, their analysts, and their investment team about ideas to understand their process. And also to leverage some of the ideas. So in this case, both these two funds, Santa Lucia Asset Management, SLAM, and Aqua Lake has contributed some great ideas to us, stock ideas. And I just like that. Transparency, willingness to share, and access to the CIO. Any information about these two funds, please contact our product team here or our private wealth management research, my colleague Garrick. And both funds presented at our CIO forum in November. And the key points are shared, also written in our latest Wealth Flash report here. A lot of my thinking today I actually borrowed from these excellent managers. They're not just excellent managers, they're excellent thinkers and researchers have done good work on things from dividend paying stocks to AI. So that's also essential in 2026 to when you have to face market volatility, we have these best-in-class managers to help us understand the situation. And we can call, we can consult with when we have any doubts or big questions about the markets. So keep in mind. Okay, before I wrap up, for most of my predictions, we have gone through in details before. For example, AI, we have probably talked about AI in at least 4 of the 5 past webinars. So I'm not going to repeat what I just said before. I do want to touch upon de-dollarization again. And I promise it will probably be the last few times I go into details, unless you are interested. The reason I want to talk about this one more time is I often see some confusion or misinterpretation of our de-dollarization theme. Our de-dollarization is not about the US dollar collapse. It's not about US debt crisis. We never believe that's going to happen. But it's really about a gradual decline of the US dollar role in the global trade, investment, and reserve systems. And the other day, I'm trying to thinking how best to explain this to you. And it just occurred to me that it's kind of like this Coca-Cola thing. I also mentioned Coca-Cola earlier, so let me borrow the concept again. So the key takeaway here for de-dollarization is to focus on the winners, not so much the losers. So as opposed to thinking, oh, the US dollar is going to go away, blah, 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 that's not the case. It's really about who's going to win from the US dollar decline. Very much like the Coca-Cola case. Over the last few years, there's actually not much growth in the usage, the consumption of Coca-Cola. Also because health reasons. I think generally speaking, people want to drink more healthy stuff. But Coca-Cola is not going away. Just like a de-dollarization, there is a de-coalization going on around the world. But Coca-Cola is still the number one, like the US dollar. It is still very dominant, and like Coca-Cola, dominant in soft drinks. But here's the story. Even a small decline or small drop in Coca-Cola market share, it could create massive growth opportunity for other drinks. So everyone, if you're in the soft drinks business, you want to go for Coca-Cola's market share. You take 1% market share from Coca-Cola, that's $1 billion business. So that's exactly the story with the US dollar de-dollarization, is that US dollar itself may be fine, but a small decline, even a small decline, gradual decline in the US dollar could create major growth for things like gold and RMB and even crypto, which I'll also touch upon. So that's the story. And there's also the stablecoin story, which I can also explain using the Coca-Cola story, which is the US is now trying to defend the US dollar. Very much like Coca-Cola will try to defend its own market share, not with Coca-Cola itself, but with other brands, other in-house brands, right? So Coca-Cola is a company not just has one brand, has many other brands. Why they have so many other brands is to actually defend its own market share, because they see these new trends emerging and they want to capture them and to make sure they're still on top. And that's exactly what the US dollar or the US is doing. So visually think about these 3 systems. You have the Coca-Cola system, which will remain dominant but decline, which I call the comparable like the US dollar system globally today. And then you have RMB. Think of RMB more like a Pepsi, right? Pepsi will never replace Coca-Cola, but Pepsi, if Coca-Cola misexecutes and somehow, you know, have some sales challenges, Pepsi could very well take advantage of that. And Pepsi have done that in the last few years, try to take advantage of Coke's misexecution or missteps. So the R&B system, think of it more like a PepsiCo, dominant system, still Coca-Cola, and then you have the neutral territory. The neutral territory is like water. Everybody drinks water. Everybody wants water. Nobody owns water. Nobody controls water, very much like gold. So gold is the neutral territory like the water. And Bitcoin possibly, I put a question mark here. Will Bitcoin fit into this neutral territory? I don't know. It is neutral, but whether it will be becoming part of the global currency system, it is still a big question mark. And where do stable coins go? Here's the interesting part. It doesn't go to the neutral territory. So people, try to compare stablecoin with Bitcoin. No, they're not the same things. Stablecoin actually go to these systems. Stablecoin is actually like a mini-maid started by Coca-Cola to defend its market share. It's part of the Coke system. Like stablecoins are part of the US dollar, stablecoins are part of the US dollar system. And Chinese will come up with their own stablecoin too, as part of the PepsiCo system. I hope this is helpful to help you understand how this works and where the various things fit. To simplify, not to complicate. So back to gold, I said earlier, it is a neutral territory. It will always be there in this global shift of currency systems. And the most common question is, where do I see gold going? Do we have a price target for gold? The answer is no. Okay, but it doesn't mean that gold will go up forever and continuously and no drawdown, no look backs. Right? In fact, if you look at 2025, gold has also experienced some volatility. And I expect this volatility to continue. And the drawdowns could be very common in gold. So when you invest in gold, mentally prepare for drawdowns. It happens, but eventually it will go back up. Okay, so how to deal with this volatility? We have some resistance support levels here for you to consider. For example, 4,500 might be a resistance level, and 3,750 is another support level. 3,400 is the level where the gold will breaks the current bullish trend. Okay, so that is a critical level, apart from the support and resistance, which are more short-term levels. 3,400 is critical. I don't think gold will go back to 3,400. But in any event, if it goes to 3,400, that means must be some fundamental shifts, some big changes happen. Technically speaking, if it's just a random walk, I don't think gold will go back to 3,400. It will fluctuate between these levels, but not 3,400. Okay. So what kind of events could trigger a fundamental shift or could help us to call the top in gold? That's also another very common question. So I said earlier, I cannot offer you a price target for gold, but I can offer you something to watch for to assess whether gold has topping out. The very important thing is whether China, if and when China will announce its true gold holdings. We all know that China has been buying gold. We all know that China has been hiding gold. And here's a report by Sotjan talking about China's gold shopping spree. It could be 10 times higher than the actual number in 2025. And China's actual gold holding could be as high as 5,000 tons as opposed to 2,000 tons. The significance of 5,000 tons, meaning China will be number one already, number two already in terms of gold holdings, just behind the US. Okay. And it will be likely going to number one someday. So the announcement of China's true gold holdings at some point is significant, is strategic, and China would do it to decouple from the US dollar to enhance the role of the RMB as part of the de-dollarization, I said earlier. And that will also mean the possible end of China's strategic buying of gold. So that could be a top for gold if that happens. And the other thing is about Hong Kong, in fact. I'm not sure you guys see the Hong Kong policy address, where this Hong Kong CEO stated that they want to make Hong Kong into a global trading center, in addition to Shanghai and London. Now, is the story really about trade or something else? I think the more interesting aspect of Hong Kong in gold is really as a custodian center, not a trading center. Of course, trading will come, but the more strategic role is as a custodian center for gold. For who? For China's allies. Countries like Russia may very well store gold in Hong Kong as part of the plan. But before that happens, China also need to accumulate enough gold to inject confidence, right? If you want to store gold with China, you want to make sure China itself has enough gold, and probably China will store its own gold, part of its gold in Hong Kong as well. That will also increase confidence. So this is another key event to watch for gold as a top. I don't know when this will happen. It may be years from now. That's another reason that we're looking at pretty long bull cycle in gold. And talking about gold, inevitably, we have to talk about Bitcoin. There's a lot of similarity between these two asset classes. Bitcoin has gone through a lot of volatility recently, and there's a lot of fear in the market. I think the drawdown is more than 30% now. But here's my point. I think Bitcoin is here to stay. Here's a table that showed you that Bitcoin has gone through more than 50% drawdowns numerous times, and multiple scams and frauds and all kinds of bad news. But Bitcoin never went away. Just to help you understand how special this is, if Wang, me as a CIO, said one thing that's wrong or made one mistake, you probably stop listening to me or believing me, right? Only one thing. But Bitcoin's gone through numerous occasions like this, bad news or these negative events, and it's still here to stay. So I think Bitcoin will be around for a long time. The key is how much it's really worth. I don't know. Nobody knows. There's no fundamental framework or methods to really evaluate how much this is going to worth. But regardless, it is here to stay, and it is a beneficiary of de-dollarization. The difference is that gold has been around for 40,000 years, going back to our cave days. When the humans started to emerge, we already started using gold. But Bitcoin's only been around for 16 years. So that is the difference. The gold has been around for much longer. And the key takeaway here is that if you like Bitcoin, there's no reason you shouldn't own gold. The logic is roughly the same, and gold is being around for a much longer time. And lastly, let's talk about Bitcoin. I don't normally talk about Bitcoin. This is probably the first time I officially talk about Bitcoin. The reason is that, I don't put much emphasis on Bitcoin itself. Much of our research is on AI, China, US, gold, etc. But we got a lot of questions constantly about Bitcoin, especially now we have such high volatility. I see more challenges than opportunities in 2026 for Bitcoin. Here are the five things that will pose a threat to Bitcoin, not just in 2026 and beyond. One is, you guys all know that we had a $15 billion seizure in supposedly safe Bitcoin from this criminal organization, Prince Group. It's a very big deal. It shooken up the world, especially in the underground markets, when Bitcoin is very common. being used for illicit activities or gray area transactions. So there's possibly a decline demand for Bitcoin because of this. The not so legal usage of Bitcoin will decline. That would reduce the overall demand. Number two is that we are seeing possibly slowing adoption for Bitcoin, especially in developed markets. Here's some numbers that almost 30% of US people already own Bitcoins. And if you ask around, especially in our business, almost everyone knows about Bitcoin, and most of the people already have bought Bitcoins or Bitcoin ETFs. So that's not a small number. I said earlier, it's only 16 years of history, but over these 16 years, the adoption has grown exponentially. So the base is no longer low. Of course, there's still more growth in emerging markets, but developed markets, we're pretty much up there. And then the threat on stable coins as a transaction tool that will reduce the usage of Bitcoin as a payment system. And this is really important. I'll talk about it in a second, why this is so important. If Bitcoin suddenly becoming just a store of value, which is kind of now like gold, less than as a currency, okay? And then number four is, this happens every time. You have lower prices, lower expectation, lower interest, lower trading volume, and lower security budgets. And this gets a bit technical, which is once the chain, the blockchain that the Bitcoin sits on is maintained by the Bitcoin miners. The Bitcoin miners pay in two ways. One is mining Bitcoins in blocks, they call rewards, and they also get paid as a part of the transaction fee of maintaining the ledger, the blockchain, right? When there's lower transaction, which is the case now, as the prices drop, I think here's the headline saying that the November volume has fallen to a record low. When you have lower volume, means there's lower pay for the miners and the lower incentive for the miners to maintain. There'll be less miners. So that's a challenge. That means it will become less secured as a cryptocurrency. And like I said earlier, if a Bitcoin just becomes a store of value, people just buy it and hold it, not trading it. It also causes the same thing. You have lower volume, lower security budget, and lower security levels. And then some people will say, well, Chi, you're wrong. Actually, we're seeing more derivatives trading. We're more ETFs trading Bitcoins. And sorry to say this, those trading, you're right, those tradings are going up. But those tradings, the miners don't get paid by those trading of Bitcoin derivatives or Bitcoin products. There's no revenue for the miners. The miners, again, only get from the revenue from the volume, only the volume, the underlying Bitcoin itself. When the underlying volume goes down, there'll be less incentive for the miners. There are more security concerns. So that is a big deal. And let's watch that closely if you're interested in Bitcoin. And lastly, of course, quantum computing, which will likely break the signature, the private address of Bitcoin, a major security concern. Some say that's only the beginning of quantum computing. We're years away from quantum computing able to conquer the security of Bitcoin. But I would say, you know, these things always move faster than expected. This is not a short-term thing. It's a long-term threat, but also a threat that need to be monitored closely. Okay, with that, I would like to wrap up today's session and turn to Q&A. If you have any questions, please use the Q&A window to enter the question, and we'll answer them in the order that they come in. Please use the Q&A window to enter your questions, please. And last time, I made a mistake of closing down the Q&A session too early. There actually were some questions that we did not answer. So this time I'll allow more time for you to digest and ask questions. Question? What's my view on spot silver? I actually don't have a view on silver. Between gold and silver, I'll still choose gold. If you look at risk-adjusted return, gold is still much better than silver. Silver is more volatile, and the upside, of course, depending on the time frame. Silver requires a lot of timing. Over shorter periods of time, silver can very well outperform gold, but it's much more volatile. It's very difficult to time. So it's one of those high risk, high return situations. And the logic is roughly the same between gold and silver. They're both commodity, both has some currency characteristics and store value. That's why it's going up. My view on Singapore stock market, I actually don't have a view on Singapore stock market. My view of silver, a short-term hedge in currency volatile market, current volatile market. No, I don't think silver is either silver or gold is a hedge per se. Gold and silver might be a hedge against currency failure, but I don't see that as a risk. So if you talk about the volatile markets, assuming you're talking about volatile stock markets, I don't see gold as a hedge because gold still has some beta, even though it's defensive. So if the stock market goes down, gold will likely go down as well. I just showed you earlier, like Walmart, right? Or P&G, you know. The market go down 5%, P&G may go down 1%. The market go down 10%, P&G may go down 2-3%. And gold, similar, very similar. When in a risk-off environment, gold will also suffer, but maybe go down less than the market. So I don't think it's a hedge. I think the real hedge is really you if the stock market, you just hedge it with the stock index, or in some cases just holding cash. That's an implicit short on the market. Again, if you have any questions, please use the chat window to enter them, and we will answer them in order they come in. Oh. Please explain how the RMB was strengthened as the outlook of weaker Chinese economy. Yes, that's a great question. The Chinese economy is not getting weaker. It's just the recovery is not as good. Okay, so the economy is still growing. People still have there's like declining. No, only real estate prices declining, but overall economy is still growing. In fact, the overall economy is still growing 5%, if you believe in the real numbers, if you believe the official numbers. So the economy is still growing. And like I said, this year, the first half, the economy actually beat expectations. So that's one aspect. So economy is not falling apart. It's just not growing as fast as expected in some cases. And next year, that will be another issue is versus expectation, how the economy is doing. And number two is, I said earlier that RMB is being undervalued for a long time. So itself already come from an extremely undervalued position. And if you compare the prices of US and China today, you can clearly see why it's undervalued. You know, in some cases, you know, the same product in China is like 1/10 of the price of the US or 1/5 of the price of the US. So you can see the pricing dislocation there, the RMB, the valuation. So RMB itself already come from extremely undervalued position. It's not so much that the economy is going well or not well, but over the next decade or so, we see that RMB will gradually normalizing. But it will not be normalizing so quickly. It will not be going up so quickly because remember, we also have a struggling real estate market. So a stronger RMB is not good for the real estate market, right? So I think the government will try to gradually increase the RMB, not all of a sudden. What is my 2026 view of China's REE and impact to the world. I don't know what REE is. If you can explain further what that acronym means. Another question on the slow transaction speed of Bitcoin. It's very unlikely to be used as a currency. Yes. Actually, there's a debate. I had a debate one time with an investor on whether Bitcoin is a currency or not. Cryptocurrencies, Bitcoin is a cryptocurrency, but it's actually not a currency. It's more of an asset. And increasingly, it's viewed as a store of value, right? A store of value. You park your money in Bitcoin as a store, like gold, as a store of value. And once it becomes a store of value, like I said, it has a transaction issue. There will be less trading, less volume in Bitcoin. And gold is not a problem. Gold does not require volume to be secured, but Bitcoin require volume to be a secured asset because the miners maintain the blockchain. Again, if you have any questions, please enter them in the Q&A window. Rare earth element, yes. China's rare. So there's a question about the view of China's rare earth and its impact to the world. I think China will continue in 2026 hold the rare earth the choke on the world and the U.S. I don't think the U.S. can build up the processing capacity so quickly. China is not just rare earth mining. I think the key issue is really the rare earth refining and processing, which is only doable in China given the more relaxed environmental control and labor, all these things. And these capacity, U.S. rapidly try to build up its own capacity, but I don't think it will be easily resolved in 2026. So rare earth will continue to be an interesting area to look at. Another question on will China roll out substantial stimulus to boost consumption? That's also a really good question. This year, I'm not sure you remember, this year we have some policy for consumption, which is surrounding the trading program, right? Electronics trading program, auto trading program for consumption. But it's not a big number. Well, it looks like a big number, 600 billion RMB or something, but in retrospect, it's not a big number. And my view is that we're unlikely to see a big consumption stimulus out of China. It's difficult to implement these consumption stimuluses. That's one thing, okay? Because China doesn't have a direct tax system where you have clarity on the household income. And there's a lot of underground income too, like under the table that we don't know about. So you can really be sure, you can never be sure, like, which are the households that need subsidy, or who are the rich people and who are the poor people that really need this consumption stimulus. So it's hard to precision target those groups. And the number two thing is it costs money. As you know, that over the years, the local government debt has become a problem. The local government financing vehicles become a problem, and the central bank now have to take over the debt swap and to somehow take on those debt burdens. That will possibly increase the budget deficit already at the central government level. So you can see the fiscal strain already in China that will limit China's ability to do consumption stimulus. And number three is about technology. I think the priority is on technology. So given the limited budget and limited spending power by the central government today, the number one priority is to spend on technology, spend on R&D, subsidize Huawei, subsidized GPUs, becoming more self-reliant in technology. That relates to U.S.-China relations. Okay, so not on consumption, even though the official rhetoric seemed like it's all about consumption, domestic demand. But if you look at the latest policy statement from the Central Poly Bureau, it's all about technology and self-reliance in technology innovation. Okay, here China has spent trillions of dollars versus consumption stimulus, I said earlier, only a few $100 billion. So you can see the scale difference, and that will remain the case in 2026. Continue to focus on stimulating technology, subsidizing technology, stimulating innovation as opposed to consumption. That will be the pattern for the very long term. Another question on the theme this year on semiconductor and AI and in Asia Pac, seeing very high growth in AI semiconductors. China also had a good rally there, but now it's losing steam. So the question centers on what will happen next year in that space. Can Asia Pacific maintain growth due to U.S.-China tension? I'm not sure this question is the overall Asia Pacific or the Asia Pacific semiconductors. I think Asia Pacific semiconductors will continue to grow because of, especially in China, we're making some breakthroughs in AI GPUs and ASICs. SMIC continue to invest in advanced capacity in partnership with Huawei as in the lead in terms of AI chips. So I think there's still plenty of growth there. I'm just not sure about the second tier players. I think very much like the US case, for Asia or China semiconductors, I will focus only on the top players, the leading players. I don't think there's room for all players in this space because it's very competitive and there are a lot of technology hurdles. I'll give you one example. For China's GPU, it's not a design issue. It's really a production issue, mainly a production issue. China definitely has the ability to design these chips. The issue is, whether you have the capacity, the ability to produce these chips. Right now, only TSMC can do it, but TSMC is controlled by the U.S. Any Huawei business need to be approved by the U.S. So that's the problem, is how we can produce that. SMIC is the only company right now in China can do this, and it's still lagging TSMC in that space. So you can see that as a growth opportunity as SMIC catches up. But having said that, not every company can do well because of the limited capacity. Here's a question on the positive correlation between safe haven assets, gold versus high risk assets this year. Yes. So this is back to what I said earlier. Michael Jordan scored 30 points a year per game on average, but does that mean it scored 30 points every game, right? So gold is supposed to be a safe haven, but does it mean that behave like a safe haven every day or every week? No. Okay, so but over the longer term, when I say long term, people just roll their eyes because think it's 10 years. No, let's say longer term. When I say longer term, let's over 6 months to 1 year. Gold had the very strong characteristics of a safe haven asset, have a good store of value, a reliable store of value, and a reliable, I won't say it's a hedge. It's not a hedge against volatile markets, as we explained earlier, but it's a reliable place to put your money during volatile markets. It's not a hedge, but it's somewhere to park your money when you want to stay on the sideline. So that's what gold's role. And on top of it, gold, I said, also fits into the de-dollarization, fits into geopolitical risk, fits into the Fed policy challenges, all these things. Gold miner stocks. Yes, that's another good question. What do I think about gold miner stocks compared to spot gold? It's basically a leverage play on gold. And we actually have done a study on this. I don't have the numbers in front of me. But again, going back to the risk-adjusted returns. Okay, so when we look at gold, we don't just look at the fundamentals. We also look at whether this asset class offer good risk-adjusted return, volatility-adjusted or drawdown-adjusted returns over a longer periods of time. And gold miners just don't offer that attractive. Again, both gold miners and silver are great timing tools. If you can time these stocks, if you can time gold, this is the best place to be. Very volatile, very high returns if you buy them at the right time. Okay, but I'm not a timer. I cannot time these things. And then don't forget, gold miners, they're actually a mixed hybrid between stocks and gold. So during market downturns, stock market downturns, they will definitely suffer from the beta. And that's also evident in the numbers. If you see the correlation of gold miner stocks and S&P 500 versus correlation of gold miner stocks versus gold, they're actually half and half. So they're both related. The beta will hurt them in a market downturn, so make them not so interesting to me. No view on China aviation oil. Sorry about that. Let me see any new questions. This question on whether when will Alibaba, JD, and Meituan stop the food delivery war, and if AI is going to slow down in 2026, am I still optimistic about Alibaba in 2026? Okay, great question. Yes. So the food delivery war, it's not just food delivery now. It's Taobao call it the flash, or the Meituan call it the speedy commerce, or whatever, the real-time e-commerce. So it's not just food delivery today. It's more about the local delivery services. The competition, as you've seen from the results of these three companies, intensifying. And regulators have already stepped in, try to ease the competition here. I think sometime in the first half of next year, we could see easing of this competition. Well, Alibaba has a lot of money. People look at the cash they have and say Alibaba maybe will come out the winner. But it's actually not just about the money. If it's about the money, Tencent would have won this a long time ago. But Tencent is not even in the business. So it's not about the money. It's really about what is a real defensive edge here. It's a moat for this service. I think Meituan has a real moat here because Meituan's been doing this for a long time and they set up the complete ecosystem for local deliveries. And Alibaba just now getting into it. So I think there's an uphill battle for Alibaba. And from the management call at the earnings conference call, it looks like Alibaba will continue to compete in this area, but don't forget, they also need to invest in AI CapEx. So at some point, Alibaba will need to prioritize between spending money to compete on subsidies to compete with Meituan, or should they put the extra dollar in AI? I think they're more likely to do the latter. And that's when I think when Alibaba step back is when we can see more benign competition in the local deliveries. The competition is not going to go away. It's just going to get slightly better in next year. And then on the AI CapEx slowdown, yes, that's a good question. The AI CapEx slowdown mainly in the US. Okay, I don't think China will see much of a slowdown in AI CapEx for two reasons. Number one, China coming off a low base. In 2024, we spent only 1/10 of what the US spent on AI CapEx. In 2025, we spent only 1/5. Okay, so there's a lot of catch up for China to do. So China will continue to grow, probably beyond expectations, off a low base, and catch up with the US. Number two is related to what we just talked about earlier, the AI semiconductor space. China continue to make progress. Huawei's Ascend chip already used for DeepSeek inference. and will likely be used. The recent news is that Huawei's Ascend GPU is already able to train AI models. So once the chip bottleneck is resolved, China can spend more money on AI capex. The third trend, I'm not sure you guys see this, is Alibaba and Tencent are moving their training offshore to avoid the U.S. Sanction, also China sanction. China also does not allow Alibaba now to use the NVIDIA GPUs. So in order to leverage NVIDIA GPUs, they'll try to move their training offshore. That will also help solve some of the problem, expedite the AI capex. So globally, US, we are cautious on AI capex. In China, we'll continue to be bullish on AI capex. My view on the banking stocks. So assuming you're asking about Chinese banking stocks or US banking stocks. We have CCB as a trading buy in our portfolio. We've been owning this for almost a year, I think. We started to like the Chinese banks when about a year ago, September, when PBOC announced plans to refinancing or capital injection for the Chinese banks. That was a big, major boost for us. I think it resolved a lot of problems in terms of the bank bad loans and the balance sheet problem. So as you know, most of the large banks have completed their refinancing or capital injection by the government. That makes us more bullish on the banks. So banks for the next 2 to 3 years, because they all beef up their balance sheet, the Chinese banks, I think they're relatively safe, quote unquote safe. Okay, and as the economy recovers, even though the progress is not as encouraging, banks can still benefit from, to some degree, the economic recovery in China. So, but it's not a long-term holding for us. As I said, Chinese banks always have this NPL issue, transparency issue, and then as China issue more stimulus. Earlier there was a question on China's consumption stimulus. I don't expect a big consumption stimulus, but China will still have some stimulus, right? As China roll out these stimuluses, it usually creates more bad debt problems. But again, it's not going to be this year or next year, okay? It's over a period of time as China roll out these stimuluses, it will gradually pile up the bad loan problem at the banks. That's when we were going to try to be cautious. Right now, I think the banks are okay, and they pay dividends, and the yield is pretty attractive, still pretty attractive. The H-share banks. Question on global index moving higher. Hong Kong, China Asia. Yes, China Asia has underperformed this year. So this question on my view about Hong Kong index and China index 2026. My view was very clear earlier. The upside will be capped by the lack of real economic recovery in China. Okay, so real side. So again, going back to Hong Kong market, we talked about this in previous webinar as well. I call this the multiverse rally. Why the multiverse analogy is because you almost two worlds in the Hong Kong market today. The index is up a lot, but only a few sectors. I would say only 3 sectors did well this year. Most sectors did not outperform the market. Why? Because the economy is not improving. Right? Technology outperformed because tech is strong, AI is strong. Healthcare outperformed because there's healthcare. They're gaining contracts overseas and they do more out licensing deals. And then the banks are relatively strong because the capital injection, all these things. But the rest, like real estate, and they're not performed that well. So that's the challenge. That will remain a challenge in 2026. When the majority of the Hong Kong sectors and the economy is not improving, then the index will be capped. And that's the same issue with China A-share, okay? So China A-share, The difference between China, Asia, and Hong Kong today is Hong Kong is actually more weighted towards new economy and internet and AI and innovation and healthcare, biotech, right? But if you look at Asia, it's still heavily weighted towards the old economy. So as China's traditional economy is not improving as much, you have limited improvement in the limited growth in the China Asia. That's the fundamental reason. And again, that will continue into 2026. I don't see, last year, my prediction is that 2025 will see upside in Chinese economy. Next year, I don't think so. So I'm cautious on Chinese economy. I'm cautiously optimistic on Hong Kong market, and Hong Kong market upside will be capped by because of lack of this real economic growth in China will continue to weigh on the Hong Kong index and China Asia as well. We're almost at the hour. Well, actually, we surpassed the time already. I'll answer the last question, and we should wrap up. And anyone who's on the call, feel free to drop off because we are already towards the end of the program. If you don't want to continue, so this question, last question, is on Enlighten regarding AI over. I never said all AI is overvalued. I said the AI capex, it will be slowing next year. The AI investor expectation is pretty high, and they may cause some volatility in 2026. Never in this session, I said AI is a bubble or AI is overvalued. We still like AI for the very long term, and suggest all of us to stay invested in the top names like Meta, Microsoft, Amazon, NVIDIA, and Broadcom. So I guess the question really regarding AI is kind of overvalued. No, I don't think AI is overvalued. Like I said, it's very subjective. Okay, what is the right price to earnings? I give you one example. People say NVIDIA earnings is expensive. The valuation is expensive, 30 times price to earnings. But are you using 2027 or are you using 2028 or 2030? Maybe on 2030 or 2030 earnings, NVIDIA P is only 10 times. Okay, so that's undervalued. But who's to say that we cannot use 2030 earnings, right? Some companies you can look forward to 2030 or 2035. In that case, it could be 5 times price to earnings, right? So it's really fundamentals, condition, valuation. When I look at valuation, I look at fundamentals first to determine whether this valuation is warranted. There's a last little question on US dollar, Japanese yen. No, I don't have a view on that. Sorry about this. Currency, I know that over the long term, US dollar would depreciate against other currencies, but Japanese yen has its own problems. Okay, with that, let's wrap up. It's already 10 minutes over time. I appreciate everyone dialing in. Please contact your UOB Kay Hian representative if we want a copy of today's presentation. Also, today's session, the replay will be put up on our YouTube channel. And feel free to watch the replay if you're interested. Thank you again, everyone, for joining. Happy holidays.